Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fajid, and let's get you up to speed on today's market action. We're still looking at losses across the board. All three of the major indices under pressure here as investors read through and sift through the latest minutes, the minutes from the latest Fed meeting last month back in July. Some hawkish commentary there pressuring the broader market. You're looking at the Dow now off just around 47 points, S&P off about 0.3%, the Nasdaq, the biggest decliner of the three, off about 0.6%. When you take a look at the sector action, real estate and communication services among the worst performers of today's trading action. And also flipping over to the bond market, we're seeing a rise in yields following that hawkish minutes here from the Fed. You're looking at the 10-year pushing further above 4%.
So let's talk about those Fed minutes as investors try to digest through last month's policy meeting. Here to break down what we have learned and what it means for monetary policy, we've got Yahoo Finance's Jen Schomburger. And Jen, we have seen the markets move on the back of these minutes with concerns yet again about another potential rate hike.
Hey there, Akiko. Yeah, that's right. And before we dive into that, I just want to note that not all Fed officials were in favor of raising rates last meeting. Minutes from the policy meeting in July showed that a couple of members actually wanted to keep rates unchanged. Now, having said that, while officials noted recent cooler readings on inflation at that time, referring to the June Consumer Price Index, they still felt inflation remains unacceptably high, and most members saw, quote, significant upside risks to inflation that would likely require further rate hikes. Now, several officials commented that significant disinflationary pressures had yet to become apparent in core services excluding housing. That's a key metric that the Fed is looking for on inflation to come down. Fed officials stressed they are data dependent and said they would need to see more data on inflation and further signs that supply and demand are coming back into better balance to be confident that inflation is moving back to the Fed's 2% target. And a potential nod to waiting till November to do another rate hike. The minutes read that, quote, participants expected that data arriving in, quote, the coming months would help clarify the extent to which the disinflation process was continuing. Now, separately, a number of officials also noted that the balance sheet runoff doesn't need to end when the Fed starts cutting rates. Now, these minutes are released with a traditional 3-week lag, so they are a bit stale, right? We've gotten a couple readings on inflation that have shown cooling since Fed officials met last month. And we have heard from a couple Fed officials, including San Francisco Fed President Mary Daly, as well as Minneapolis Fed President Neil Kashkari, that perhaps even despite those cooler readings on inflation that we've gotten since July, that there is more work to do. So the latest comments buttressing what we saw in these minutes. Now, all of this coming ahead of Fed Chair Powell's expected major policy speech next week in Jackson Hole, Wyoming. This is an annual affair. This is something that the Kansas City Fed puts on every year, their annual economic symposium. And traditionally, Fed chairs have really used that forum to make a major policy speech. So we will hear from the Fed chair himself next Friday, where he will probably take the opportunity to set the stage for monetary policy this fall. Just want to note, when Powell spoke last year at this very conference, he set the S&P 500 down better than 3% on that session. Back to you.
Yeah, we all remember how short that speech was last year. But Jen, I know you're going to be on the ground for us in Jackson Hole. Looking forward to the coverage there. Jen Schomburger with the very latest on the Fed minutes today.
Well, investors are weighing the minutes from the last FOMC meeting, and while those minutes did reveal that some members wanted to leave rates unchanged, officials are still thinking that inflation is too high and more rate hikes may be necessary. For more on what this means for the markets, we want to bring in Mahmood Noorani, CEO of Quant Insights. Mahmood, great to see you here. So let's compare what the Fed is telling us, at least the minutes, what we're learning a little bit more about the discussions that were taking place ahead of the Fed decision last month, and comparing that to what the market believes, because by and large, the market is still expecting or still optimistic that the Fed's done raising rates. Is the market being too optimistic with how they're reading the Fed's possible moves?
Yes, I think the market has been too optimistic, and you've got to bear in mind that in a good decade after the financial crisis, financial markets got used to very low inflation for a long period of time, and so that mindset is very much there. And equity markets have been pricing this soft landing or Goldilocks scenario, if you want to call it that, for some time. The Fed has continued to push back against that, and this is the latest pushback. And I expect more pushback as we get to Jackson Hole.
Mahmoud, the minutes, though, today, does that change your base case in any way? I mean, the reality is, if you think back to the last press conference from the Fed chair following the FOMC decision, it really was about optionality. He's never ruled out another rate hike.
Correct. And I think there's two camps at the Fed. There's one camp that is basically going to focus on how long rates need to stay at these levels in order to cool the economy down. And there's another camp that I think these minutes show is quite strong, which doesn't believe that the current rate level, even for a long period of time, is going to be enough to bring inflation down to target. And let's face it, we've been expecting a recession given the inverted yield curve for something like a year now. There is no recession. Real GDP growth in Q3 is tracking something like 2%, according to nowcasting. Unemployment is at historically very low levels. Average hourly earnings actually ticked higher from 4.2 to 4.4%. Core inflation is close to 5%. If you look at the hard data, there really isn't any clear sign that core inflation is going to head south. And we know the story behind this. We have very strong service sector inflation. The service sector is a very big part of the US economy, probably 2/3. And, wages are rising too fast for the Fed's comfort level.
So then, Mahmoud, what does that mean just in terms of the timeline here, the Fed's fight against inflation? How long could that potentially take if we were to ever see it come back to that 2% target?
I think we're much earlier in that process than the market thinks. And what's really driving that is that a good part of the core inflation we are seeing is structural rather than cyclical. In fact, the San Francisco Fed published a paper a few months ago showing that something like 2/3 of the core inflation rate right now is structural. And those structural forces come from things like demographics, 100,000 baby boomers retiring every week, immigration levels much lower than 5 to 10 years ago, deglobalization, shifts away from fair trade and towards, shifts away from free trade and towards fair trade. And of course, we have moved away from offshoring and we are now much more focused on onshoring. And so all those structural forces, I think, are the things that the market isn't really fully appreciating. And I would expect rates to stay unchanged into next year or potentially higher, depending on wage growth.
We are right in the heart of retail earnings this week. We've gotten a better read on the consumer. Based on what we have heard from some of these big names, what we keep hearing, Mahmoud, is that the consumer is cautious, but that some confidence is returning. I mean, what is your read based on what we have heard so far?
Yes, the US consumer has been surprisingly strong. I think if you had asked people 18 months ago what would happen if rates went from 0 to 5.5, they would not really be expecting the current strength of the US consumer. And what's really remarkable in the US is how interest rate insensitive the economy is. And that really comes from two places. Number one, throughout the COVID period, corporates locked in a very large amount of debt at low levels. And something like 60% of that debt is locked into 2030. So they've insulated themselves against the interest rate increases. There's also been a lot of focus on the US consumer increasing credit card debt to keep going, and that hit 1 trillion recently. And the 35 million Americans who own their home outright is also an area of focus. And I think there's been a little bit of a mystery. Why is the consumer so strong? And I think there's been a bit of an attitude shift. Consumers, there's the whole sort of COVID revenge travel season going on. Travel prices are up 30 to 40% in the US and in Europe. A lot of the travel and leisure sector is on fire. All the hotel groups have done very, very strongly. Booking.com, Hilton, Marriott, Intercontinental. And so I think the consumer to some degree is living a little bit on borrowed time. And all those chickens may come home to roost later this year.
So then what would that potentially look like?
I think that would look like a stock market that goes from pricing this soft landing to a stock market that starts to actually rotate away from cyclicals and towards defensives. And of course, there are global forces at play. If you look at the data out of China recently, it's been really awful. Manufacturing production really collapsing there. Imports down, exports down, home prices down, the currency weakening. China is, of course, the second largest economy in the world. The Eurozone, which is heavily geared to China, is weakening in terms of growth. It was interesting that Siemens in Germany recently said that their order book is down 60% from China. So I think there's an element of sort of the roadrunner economy going on in the US. And the Fed is clearly saying that there's not going to be any easing. Just take that off the table for the rest of the year, given the information we have.
So Mahmoud, what does all this mean for positioning? You talk about the fact that there is so much risk out there. Maybe we could see this rotation out of cyclicals. How should investors be preparing for what sounds like a very uncertain several months?
Yeah, I think the obvious plays are to reduce exposure to interest rate sensitive sectors. You mentioned real estate wasn't having such a great day today. Reduce exposure to cyclical sectors such as travel and leisure, and move into the more defensive sectors like utilities and consumer staples.
When we're talking about retail, what's your positioning in retail? What are some of the names that you like?
I haven't got a good answer on that one. I haven't really looked at the names in that sector recently, so I can't be too helpful, sorry.
All right, Mahmoud Noorani, always great to get your perspective. Maybe next time we can get some of your specific picks on retail. Great to have you. Thanks so much.
Thank you.
Let's talk a little bit more about retail because Target, one of the outperformers in today's trading action, bucking that downward trend that we're seeing up just around 2.5%. The move coming after the retailer reported a big profit beat, and that's overshadowing Target's second quarter sales decline and also a more cautious outlook. We heard the tone here on the earnings call. Also, CEO Brian Cornell holding a call with a journalist, with reporters last night at Kiko, pointing to the fact that there are certainly a number of challenges, a number of headwinds that remain between now and year end. One of those, obviously, and we've talked about it before, the resumption here of student loan payments. And Target, which is more discretionary, relies more heavily on discretionary purchases, clearly could have a tough couple of months.
Yeah, I mean, the general trend is kind of what Mahmoud, our previous guest, touched on, which is this transition that we've been seeing to services from goods. And we heard that repeated yet again today on the earnings call today, talking about how consumers are really opting for more experiences and eating out, not necessarily spending on discretionary items. So they have seen some weakness on that front. One of the things that struck me, though, was the comment that came through from Chief Growth Officer Christina Hennington, who said with inflation rates moderating, we're starting to see consumer confidence begin to recover from recent lows. You know, look, maybe not the first person to say that, but it is certainly promising, or at least welcome, when you consider it's coming from one of the biggest retailers. We've sort of said, you know, look, there's a huge divide in some ways between what we have seen in terms of the confidence coming through from consumer versus the actual spending they've been doing. There's been a bit of a divide there. It feels like coming from Target, though, they are starting to see some of that narrow as well. The other thing I think investors were really interested to hear more about was the impact from that backlash for Target on offering some of those goods during Pride Month. They did talk about that, Brian Cornell addressing it head on, saying they're going to try to find a better mix here, saying specific to Pride and Heritage Month, we're focused on building assortments that are celebratory and joyous, trying to find that medium ground, Shauna, but another lesson in companies having to sort of toe the line when it comes to the touchier cultural issues, you should say.
Certainly, and there was also so much worry and so much of that risk, it seems like, already priced into this stock, right, going into this report, because when you take a look at the numbers, it wasn't that impressive of a report. They still saw that decline in sales. They still cut their guidance. So it really shows the underperformance of Target when you compare it to its biggest rival, Walmart, and the discrepancy there. And I guess investors at least satisfied enough with that profit beat for now.
Yeah, with that stock up about 2.5% today. Let's take a look at shares of Tesla trading lower, down about just over 2.5% after more price cuts in China. The EV maker slashing the prices of its Model S and Model X each around 7% in China. This comes against a tough backdrop economically, Shauna. When you think about what's been playing out in China, we were talking about this yesterday, the latest economic data pointing to continued weakness in the market. Should note these price cuts coming back in the market after Tesla, along with 15 other car makers, essentially signed a letter saying that they won't be competing under abnormal pricing. But this shows you how competitive the market is, and Tesla certainly not alone in pushing for this. Their Chinese rivals have been cutting prices as well. But, you know, I was thinking back to the comments that we got from RBC's Tom Narayan yesterday, who said there's too much concern around the price cuts because at the end of the day, if you've got higher volume, even with the lower margins, that's a positive for the company.
Yeah, and that's at least, it seems to be how Elon Musk is looking at it, because he's remained, at least for now, committed to these price cuts, always leaving the door open for more. We talk about the demand picture, what exactly that looks like. Obviously, over in China, the slowing, the very, very slow recovery that we're seeing, all the problems, the disappointing econ data that we've gotten out over the last several weeks, certainly painting a tough picture for Tesla and obviously those domestic players there. So Tesla needs to do all it can to better compete with those domestic players. How much pressure this is going to place on margins, at least in the near term, we see some analysts a little bit more concerned than others. Jan Ives of Wedbush is also one of the analysts that does think it's a smart play in the end and will eventually benefit Tesla. It could put some pressure, though, on the stock in near term, and we are seeing the stock off just around 2.5% today. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, the Inflation Reduction Act turns 1. We will speak to a White House official about the impact of Biden's legislation so far. And Disney coming under pressure from its slowing parks business and also linear TV division. CEO Bob Iger saying that he'll consider selling off parts of the business, but one analyst is taking it further, saying the company should be broken up. And the Federal Reserve wants to get inflation down to 2%. Find out which city has already beaten that goal. This and more when Yahoo Finance returns.
Well, today marks the first anniversary of the Inflation Reduction Act, President Biden's signature climate bill that set aside billions of dollars for manufacturing investments in clean energy and EV tax credits. It also aimed to lower the cost of healthcare and prescription drugs. Analysis from Bank of America shows 270 new clean energy projects have been announced to date, with investments totaling $132 billion. President Biden touting it as a massive success, but polls show Americans still don't know much about the administration's efforts to reduce inflation. And we should mention emissions. Joining us now is White House National Economic Council Deputy Director Bharat Ramamurthy. Bharat, it's good to talk to you today. The numbers in terms of investment certainly impressive, but it almost feels premature to talk about the impact ultimately to climate policy, because these really are long-term projects we're talking about. In the first year, though, how would you grade the progress that's been made?
I think there's been incredible progress. I think even better than a lot of what people were projecting when this bill was passed. I mean, you're right, of course, that we have to evaluate this over the long term. One projection has estimated that we are reducing greenhouse gas emissions by 1 billion tons between now and 2030, thanks to this bill. That's obviously tremendously important for our efforts to combat climate change. It's also, as you noted, already spurring significant amounts of private investment, well north of $100 billion already, and projections for well over 100,000 new jobs created in the fields of the future. One important thing to note here is that there's going to be a multi-trillion-dollar global market for clean energy over the next several decades. And we in the United States should be leading the way, not only to reduce our own emissions, but also in pioneering the kinds of efficient clean energy technologies that the world is going to need, so that we are in a position to export those products abroad and bring in more money to the United States and create more benefits for American workers. That's really what the Inflation Reduction Act has positioned us to do.
And Brett, when we talk about that, the benefits here for American workers, it's no secret in the Biden administration, you have been very transparent with the fact that it has not been registering with voters. When you take a look at all of the recent polls, majority of Americans don't really know what it is. And you guys have started to address this a little bit. But when you talk about changing your messaging here, what more does that then look like?
I think that there are aspects to the Inflation Reduction Act that are already making tangible improvements in people's lives that people are familiar with. So, for example, one of the things that the Inflation Reduction Act did was cap the cost of insulin at $35 a month for people on Medicare. Of course, there's millions of people on Medicare who rely on insulin that was previously costing, in some cases, several hundred dollars a month. That's a concrete benefit that people have already started receiving. And if you ask the public, have you heard about that provision and how do you feel about it? The response is very strong. I think that over the next several months and years, as more and more of the benefits of this law become apparent to people, I think that appreciation for it will grow. Part of this is about politics, of course, but ultimately what we are doing, what the president has an obligation to do, is to be a good steward of the economy and make sure that America is positioned to meet its global obligations, to reduce greenhouse gas emissions, that America is delivering good jobs for American workers. We are doing that at a quite a historic pace. I think by any objective metric, the United States has had the strongest economic recovery from the pandemic, both the highest growth and currently the lowest inflation of any leading economy in the world. And we would expect that will translate to political support over time.
There's no question a lot of progress has been made over the last year in bringing inflation down. The Fed has been very aggressive in hiking rates, but we're still off that 2% target that the central bank has set. North of 3% inflation is what we're looking at right now. As you sort of assess what's needed to get to that last mile, how much of that do you think has to do with central bank policy? How much of that do you think is fiscal policy that potentially the administration can push through?
Well, first, as you noted, of course, we've made an extraordinary amount of progress over the last year. Inflation at the headline level has gone from about 9% to, as you just noted, close to 3%, two-thirds reduction in just a year. At the same time, as we have been adding jobs and wages have continued to rise. So obviously, that's a number of good economic trends converging there. But we continue to think that inflation is on a positive trajectory. We're not going to get to the 2% target overnight, but we're clearly tracking towards that target. And I think that we in the administration are committed to doing what we can to help the Fed achieve that goal. We did that with the Inflation Reduction Act, which results in a significant reduction in the federal budget deficit. And the president has put forward several plans that would further assist this, including new tax increases on the very wealthy and on big corporations that would bring down the deficit further. We are eager to work with Congress to try and get as much of that enacted as we can. But ultimately, as I said, we think that we're on the right trajectory now, and that inflation will continue to come down over the next several months.
So then, Bharat, what do you say to the critics out there who actually say the Inflation Reduction Act, it's spurring inflation?
Yeah, I just don't see the case for that. A lot of what the Inflation Reduction Act does is expand the productive capacity of the economy, expand the supply side of the economy, which is, on the whole, net positive for bringing down inflation. These are good incentives for businesses to invest, bring more people into the workforce, get more people paychecks, expand the productive capacity of the economy, and I think on the whole, be net positive for inflation reduction. And in addition, as I noted, it will reduce the budget deficit, which will also have a positive effect on bringing down inflation. So I don't see the argument that the Inflation Reduction Act has had a counterproductive effect. And I just think the proof is in the pudding. In the years since it's passed, we've seen inflation come down nearly 2/3. I'm not trying to say that those two things are directly causative, but I do want to point out that if we were fighting in the wrong direction, you may not have seen that kind of sharp reduction in inflation.
Specifically on the issue of climate investments, there's some concern that, I guess that the good thing is that the U.S. has really spurred a lot of investments as a result of the incentives that have been offered through the IRA. But a lot of developing countries have been left out. The U.S. has offered the incentive. Europe has responded with that, with additional incentives. And yet you look at some of these developing countries who are trying to take advantage of this clean energy transition. They don't necessarily have those incentives to offer. How's the Biden administration thinking about that? And what are the conversations that you're having that could potentially, put the U.S. in alliance with some other countries to help them make that transition, even if they can't bring in that kind of investments the U.S. has?
Yeah, it's a good and important question. We have been committed through the Inflation Reduction Act, which obviously encourages more clean energy production in the United States. We've also been in close contact with our allies in Europe and elsewhere to work with them on making sure that they can benefit from some of the provisions in the Inflation Reduction Act, and also that they can create their own pathways to bringing more clean energy production to their countries. We've seen that in Canada, we've seen that in the EU and elsewhere. Ultimately, these investments, which are going to help make more potent clean energy technologies, more efficient clean energy technologies, cheaper clean energy technologies, that's going to benefit the world. Countries that may not be in a position to provide the same kinds of incentives will ultimately benefit when they are able to take advantage of the technologies that are being developed, whether it's in the United States or elsewhere. And we have to work together globally to address this because it's a global challenge. And I think one of the most important things that we can do globally is to bring down the cost of clean energy generation, bring down the cost of battery storage and so on. And the Inflation Reduction Act is going to supercharge those efforts and I think help lead the globe in a better direction.
Bharat Ramamurthy, White House National Economic Council Deputy Director. It's good to talk to you today. Appreciate the time.
Thank you.
Well, the month of August has been tough for stocks so far, and we could be in for some more uneasy times ahead. Jared Blickery is here with a closer look at some of these details. Oh no, more losses?
Well, possibly, or just sideways action. Frustrating investors. I think investors know what frustration feels like. Here is a chart of the S&P 500 and what usually happens in a year when we've been up 10% or more as of the end of June. That is this orange line right here. The green line is what's actually happened this year. So we had that huge surge now Nasdaq was up about 30% into the end of the second quarter. But what usually happens is stocks just tend to trade sideways into early November, and then they continue their ascent into the end of the year. That's a well-known Santa Claus effect right there. But there's another way of looking at seasonality here that's very similar, and that has to do with the pre-election years. This happens once every 4 years. So we got the election this November, going to have a new president next year. And very similar to the chart I just showed you there, we tend to trade sideways over these late summer months into the election, and then you see some liftoff into the end of the year. So all of this speaks as to what could potentially happen next, but a lot of this has to do with the interest rate structure and what's going on in the bond market. Here is the 10-year T-note yield. This is up. It's about to settle, or it just did, at the highest price in years. And in fact, when we've seen the 10-year T-note yield spike above 4%, as it has this month, and it did a little bit earlier in the month of July, is we tend to see equities weakness. So you take a look at what's happened. We've seen some down movement in the indices. Here's the S&P 500. Here's the Nasdaq in the month of August. Definitely seeing that downtrend. Now, when does this resume? Well, it could be when interest rates back off a little bit, when people are less concerned about the Fed maybe having to hike even more, and also with the U.S. dollar, because the U.S. dollar has been trending higher as well. This acts as a headwind for stocks, and we've seen it come up against this level here. That's about 103.5. Going to put a 5-year chart in. Well, that could be simply the end of its run for now, just based on some simple technical analysis. And if the U.S. dollar does roll over, well, that would be a tailwind for stocks instead of a headwind. And just want to show you what's been going on in the month of August. This is today's action, only utilities up, but month to date, we've had about 11 trading days so far. Only healthcare is positive, arguably a defensive sector. And then you can see energy off about 0.5%, but tech, which was one of the most successful returns of the year here, has given back 6.5%. So we might be in a bit of a holding pattern for a few months until we see some liftoff. That's just seasonality, but that's kind of the way the wind falls anyway, guys.
Yeah, you certainly have seen a rotation out of tech over the last several days. All right, Jared, thanks. Well, coming up, Bob Iger admitting that Disney's current linear TV distribution model is broken, but could splitting up the company help? Find out next. Disney CEO Bob Iger facing a series of headwinds, from box office bombs to slowing park revenues and a linear TV business that's in free fall. Well, while Iger is seeking solutions to some of those issues, one analyst is suggesting that the entertainment giant should consider breaking itself up. Yahoo Finance's Alexandra Canal is here with the details. Allie, what's the case for this?
I know, it's a loaded question, right? And this was first introduced by MoffettNathanson analyst Michael Nathanson. He asked Iger point blank on the earnings call, would you consider splitting Disney into two companies? And this is his thesis. Company number one would be the good part of Disney. So that would be the theme parks, Disney Plus, and the film studios. Obviously, that studio IP incredibly important. And company number two, that would basically be the bad stuff that you don't want. The linear networks, which Iger has already suggested that he would want to sell off. Now, this is complicated with ESPN, since Iger has been very bullish on ESPN. He eventually wants to take the network fully over the top as a direct-to-consumer service. And you'd also have Hulu with the live TV option as well, and the Disney Plus Indian brand, Disney Plus Hotstar, would be included in company number two. So he says that would allow Disney to unload some of that debt, would allow it to create more value on the good parts of the business, because he thinks right now within the current structure that's undervalued, being dragged down by some of those linear network headwinds. However, it's very complicated because Disney is a company that really feeds on different parts of the business to run the engine. The parks feeds off of the studios, the success there. Linear networks, that generates a ton of cash that Disney can then feed into the streaming side of the business. So I spoke with Bank of America analyst Jessica Reif Ehrlich, who said she's not necessarily in the camp that Disney should separate itself. That being said, Bob Iger has made it clear that there are a lot of options currently on the table, and that is certainly one possibility that you could see down the line. And it's something that we've heard a lot in Hollywood, right? Unlocking value. Paramount Global, that's one company that's often been looked at as a company where you could probably get a lot of value for parts of that business. So if you sell off BET, if you sell off Showtime, which there's already been reportedly interest from a lot of buyers, that could unlock some value. We've seen Lionsgate spinning off its Stars business. So this is something that's really a phenomenon, especially for these legacy media companies that are going through a lot of challenges right now. The question is, though, is this the right move for Disney specifically?
Well, I mean, the other question, Allie, I have is, number one, is it the right move? How realistic is it? But also, then what happens to those linear assets? And I'm not just talking about Disney. I mean, you just brought up a point of companies trying to unlock value. Nothing in that proposition points to the linear assets that exist. So then what happens?
Yeah, and I think that's a good point. Who will buy the linear networks, especially if ESPN is not included in that, right? ESPN is one of the biggest value propositions. And Jessica Reif, she brought up an interesting point, too, that how can ESPN maintain its value if it's not on ABC and you don't have access to some of those stations? Yes, linear viewership is declining, but the reach that has is still very significant and is still largely tied to the ESPN part of the company. And that's something that I don't even think Bob Iger has fully figured out. There have been some articles out there that he's a bit anxious about this, although he did put it out there to the world. If there's anyone interested, I'm open to conversation. So he clearly knows he has to do something. The stock price has been on a decline. There have been a lot of challenges throughout different parts of the business, even the parks, which has long been the storied part of the entire company, really the lifeline. There's been some softness there in terms of attendance. So you need to shake things up. And even Iger said on the call, I'm not sure what that is yet. I'd welcome different types of opinions. Now he has Kevin Meyer, Tom Staggs, former executives at the company, advising him on this. So that's something that I think he's very focused on, especially even before we can name a successor, which is part of the reason why they extended his contract.
He certainly has some tough decisions to make, it sounds like, over the next couple of years. All right, Allie, thanks.
Well, inflation is coming down across the U.S. with the annual rate sitting just above 3%. That is still above the Fed's 2% inflation target. But one city has managed to get ahead of the central bank. Rates in Minneapolis fell below 2% in May. Now they are down to 1%. The decline largely attributed to the region's push to increase affordable housing. For more on this, we turn to Peter Frosch, CEO of the Minneapolis-St. Paul Regional Economic Development Partnership. Peter, it's good to talk to you. You know, I want to preface this by saying we're talking about affordable housing because shelter, which includes housing costs, is the single biggest contributor to inflation that we're seeing right now. But your plan in Minneapolis, and I mean your as in the city's plan, began before the pandemic. Walk me through how the city approached this issue differently from others, why you think that has brought down inflation to where it is today.
Right. Well, we appreciate the attention on the issue. We're excited about these numbers. It has a lot to do with anticipation. I think what we've seen across the country is that if you're waiting to work on house price inflation, once that trend is really running and multiple years into it, it's very hard to get a hold of. So back in 2015, 16, 17, regional leaders across Minneapolis, St. Paul got together. We have a shared practice of tracking key economic indicators, and we saw that housing prices and rental prices were starting to go up and at a rate that we hadn't seen before. And that sparked kind of a real focus among leaders across the region, even those who weren't focused on housing, to say, what's behind this and what do we need to do to get ahead of it?
So, Peter, when you talk about the fact that you have made progress, the fact that it's under that 2% level that the Fed's struggling to get to on a national level, but how do you keep this trend going when you talk about keeping Minneapolis more affordable when you compare it to cities of similar size? How do you maintain that advantage?
Well, I think the way that we got here is by having an all-in approach. There's no single solution. There's no single responsible party when it comes to managing housing costs. And it has certainly to do with income, but it's also production. And so together, the region created a set of production goals of 18,000 units a year, which over the past 3 years, the region has exceeded. So that focus on production is key. And one of the reasons I think we've collectively been successful in this geography around production is because you have a lot of creativity and innovation happening regarding housing. So one of the areas around transit corridors, we've had 20 years of major investments in transit infrastructure, and that has unlocked a significant amount of private investment into housing and multifamily housing at affordable and market rate along those transit corridors. Added to that, you had a focus in Minneapolis and St. Paul going back to 2010 and 2012 around converting downtowns into neighborhoods. And so I think there was some data that came out in the last few days showing that Minneapolis has seen some of the highest rates of conversion of office into apartments of any of the downtowns in the country. And then we're reinventing spaces. So suburban malls, golf courses, major industrial zones have all been in the process of being converted into multi-use spaces that include significant amounts of housing. And that's been going on for a number of years.
So some creativity in your approach, but how do you get all the players, the stakeholders on board? Because some of those ideas you just pointed to, we have seen them proposed in other cities, but it's mired in red tape. There's often a lot of pushback from the local community about expanding affordable housing. I mean, how do you get those competing, or how did you manage to get some of those competing interests on board?
I think part of it has to do with the nature of the geography of this region. For those who aren't as familiar with Minneapolis-St. Paul, the city of Minneapolis is only 11% of the total population, which is roughly 3.7 million. And so you have dozens of cities, all of whom are under pressure to generate solutions. And so it kind of creates this ecosystem of innovation around housing. And I think that's really at the root of what we've seen, that you have a lot of responsible parties who have different options depending on the part of geography they have. The city of Minneapolis has done some really important things, not only in terms of investing in its budget, but several years ago, prior to the pandemic, it was, I believe, one of the first, if not the first, major U.S. city to eliminate single-family zoning, which takes a number of years to work through the system, but it's a very powerful signal about kind of signaling, a new sense of innovation and new aggressiveness in terms of how we as a place need to address the issue of housing.
To what extent do you think this can be replicated on a national level? I mean, we talk so much about inflation and rising costs, and yet it feels like your model really points to the importance of local and state efforts.
Yeah, I think it's a kind of a shared responsibility model. that's got a strong bias towards action and experimentation. So not everything that has been going on here has worked around housing, but I think there's a lot of visibility and real-time sharing about that. And the nature of that experimentation has enabled some de-risking. So, one suburban community will try something, others are seeing it when it works, it speeds adoption in other locations. I mean, other places have suburban malls, they have former industrial zones, they have downtowns and transit corridors. So none of that is necessarily different. I think it maybe has to do with the focus. And then also having goals and tracking those goals is always useful. And I think that might be one of the distinguishing characteristics in our region.
Yeah, setting those markers so you can track progress, certainly a very important thing. Peter Frasch with Minneapolis-St. Paul Regional Economic Development Partnership. Appreciate your time today.
Thanks very much.
Well, U.S. home building surging in the month of July. We're going to break down what it could mean for the housing sector and the economy. That's coming up next.
Home building activity accelerating in July as existing inventory for buyers remains historically low. Now, housing starts of single-family homes jumping nearly 7%. But as mortgage rates climb, could that put a dent in future construction? Here to talk a little bit more about that, we want to bring in National Association of Home Builders CEO Jim Tobin. Jim, it's good to see you here. So on the one hand, housing starts have really been the outperformer in today's real estate market, given the fact that inventory of existing homes is so low. But then you're also competing with the higher rates. That's sidelining some buyers. So what does all this then mean for construction and demand for construction going forward?
Well, good afternoon. It's great to be with you. What it means is we're going to continue to see this kind of yo-yo effect from month to month, with permits being up, then they're down. Our HMI, our Wells Fargo HMI, that's up and then it's down. So it's kind of a mixed bag. I think what we are seeing is that the Fed's efforts to crush inflation are in turn starting to crush demand in housing. 7% mortgage rates are really keeping people on the sidelines, keeping people in their home, their existing homes, which give construction kind of an outsized portion of the for sale market, or new construction outsized portion of the for sale market. So construction looks good, but we're still facing the headwinds. Lending for construction loans, that continues to be very high, as well as construction costs. And labor concerns continue to be a drag on new home construction and new apartment construction.
Yeah, I mean, single family homes there, the growth that we saw on that front sort of outweighing the declines on the multifamily front. I mean, how sustainable is that cycle when you consider the demand? I mean, can we call it demand destruction? Because we are seeing mortgage rates push higher. That's sort of sidelining a lot of sellers as well as buyers.
Demand is still there. It's just the question of reminding people that it's still a time to buy a home. If you are a credit-worthy borrower and you have some money to put down, it is worth getting into this market. And new construction is now a part of the market that people are starting to take a better look at. And now it's time for our local lawmakers and our state lawmakers and our federal lawmakers to do everything they can to clear the way, whether it's government regulation or land use policies, to help us continue to build that new product. Because again, demand remains strong even despite these high interest rates. And what we're seeing is on the new home market, we're starting to see our builders put in more incentives to attract people into the market, with lowering prices or are doing rate buy downs. People are doing more and more. Our builders are doing more and more to get people into home ownership because they know demand is high despite these mortgage rates.
Yeah, Jim, you've been calling for the government to do a bit more to help make housing more affordable. From your conversations, are you confident that we'll see anything over the next several months, given the fact that some of the dynamics that you were talking about still makes it a pretty tough time for people to afford?
Yeah, when we're at all levels of the government, we're talking all of the time, and the challenge is that everybody recognizes that housing affordability is a problem for most Americans out there, whether you're a new first-time home buyer, first-generation home buyer, or a family looking to move up. It is hard times out there. So what we need to do is get lawmakers to find a way to speed up the permitting process, stop with review after review after review, and let our members build. But you also have the challenge right now. We're facing the headwinds of climate change as well, and the regulations that the federal government is imposing on new construction, specifically when it comes to energy codes and even resiliency codes. I mean, there's so much cost that goes into a house, so much regulation, that we need lawmakers to recognize that every regulation is going to add to the cost and drive people from home ownership. We have to make a balanced decision about good regulations that do good for health, safety, in the built environment, and be mindful of what it costs for people to own a home.
What are those delays? I mean, what kind of timeline are you talking about, and particularly around climate? Because there are new regulations that are being introduced every year as a result of the changes that we're seeing.
Yeah, a lot of it has to do with the building materials that go into meet climate requirements. So if, for instance, 10 or 15 years ago, a lot of wall and ceiling construction was 2x4 construction. Now, in order to meet some of the energy requirements and insulation requirements, you have to use 2x6 construction, and 2x6s are more expensive than 2x4s. That is a great example of just the cost of construction when it comes to energy efficiency. It has to do with our effort to try to meet climate change, sure, but we're not balancing home affordability when it comes to these issues. It's really frustrating times. 10 years ago, you could build an average single family home in about 3 months. Now it is stretched to 8 months, and as you know, time is money. Mortgage rates change in that time frame. So it's just delays and regulations really continue to be the biggest drag on the industry right now, especially when we talked about new home construction making up a bigger and bigger portion of the for sale market.
Jim, always great to talk to you. Jim Tobin, CEO of National Association of Home Builders. Thanks.
Thank you.
Well, let's turn our attention now to the latest craze taking over the healthcare industry. We're, of course, talking about weight loss drugs. While their popularity and success so far is helping lift the companies that manufacture them, there are growing concerns about a number of scams. Yahoo Finance's Anjali Kamlani is here with the details. Anjali.
Thanks, Akiko. Yeah, so we know, of course, that these drugs are so popular that they're creating unprecedented demand for them, including putting them on the FDA shortage list. So what are we talking about? We're talking about Wegovy and Ozempic. Those are the weight loss and diabetes drugs from Novo Nordisk, as well as Mounjaro from Eli Lilly. The active ingredients in those drugs is what's of interest right now. Semaglutide, the most popular one, of course, we'll use that as the example. If you just Google, you will find hundreds of thousands of offers, whether it is for medical spas, telehealth activity, or any other outlet. And so that's where the concern is. There have been FDA notifications and warnings about these. The Wall Street Journal also reporting that they tried to dig into some of these offers, including labs that claim to be selling these for research. So where is it authorized and not authorized? Let's review that for a second. You've got the doctor's office and some telehealth companies, as well as some compounding companies. I'm going to get into that in a second. You've also got these areas where you're getting offers for what may not be the original Ozempic or Wegovy Mounjaros, and those are medi-spas, weight loss clinics, those research chemical sellers who say that they're selling it for research or for laboratory use, and supplement companies. None of these are likely to have the specific prescription, and they offer these drugs without prescription, which is a key flag to look out for. And so in this frenzy, what we've seen is sort of this black market coming up at a time when there's also a shortage, and that's created a lot of concern for the FDA. They've put semaglutide on the FDA shortage list, which means that some compounding pharmacies can, in fact, and are authorized to produce them. We've also seen, though, Novo Nordisk go after some of those pharmacies as well as those weight loss clinics that are offering without or even with a prescription, but for compounded formulations. There are home kits being offered, as well as a notice about not semaglutide itself, but in fact, a variation of it being put into formulas. We've also seen some of those with B12, for example, some of those medi-spas saying we've got semaglutide with B12. So all of these are likely scams. A lot of them are, especially if they're mixed this way. And so it's something to be on the lookout for if you're trying to get your hands on those products. Right now, there is such a shortage of them that even these drug makers have stopped advertising them. And yet we've seen the proliferation of ads everywhere you go. So it's something to look out for and really is causing a problem for the companies as well as the regulatory body.
Certainly very important to be aware of. All right, Anjali Kamlani, thanks. Well, coming up, the closing bell on Wall Street, we're checking in on some of the latest market moves. We also got to look at some of the top trending tickers. Stay tuned. That's a closing bell on Wall Street. Let's do a check of the markets. All three of the major averages closing lower, some pressure across the board following the release of the minutes from the last Fed policy meeting. When you take a look at the Dow closing off just around 180 points, S&P off about nearly 0.8%. The Nasdaq, the biggest decliner, closing off just over 1%. Well, so retail earnings out this week that are telling us a little bit more about the consumer. Before the bell this morning, we heard from Target ending the trading day up nearly 3%. Now the move higher on the profit beat, but ultimately the retailer slashing its full year profit outlook, warning about economic conditions, rising interest rates, and uncertainty from the restart of student loan repayments here. And then on the other hand, we also heard from TJ Maxx, the shares there closing up just about 4%. A very strong report from this company, much stronger than the street was looking for. A full year outlook also being raised here to the upside, posting an annual sales jump, also a double-digit rise in profits here. So, Kiko, we talk a lot about the consumer, the fact that the consumer has remained so resilient in both of these earnings calls here from Target and from TJX, the parent company of TJ Maxx and Marshalls there. They were optimistic, but they did say that the next couple of months could be a bit challenging, given the fact that some people are pushing off some of their discretionary purchases.
Yeah, I mean, you hate to pit two companies against each other, but those are two diverging stories right there you just presented. I mean, Target, yes, still offers value, but they are seeing consumers pulling back from discretionary spending. You look at a name like TJX with stores like TJ Maxx, Marshalls, Home Goods. I mean, that is where the discounts are. And we are seeing traffic up there in all of the company's divisions. That points to where consumers are thinking. Yes, they're turning a little more cautious. They want to spend a little more, but they want value. And that's what this company offers. It's interesting. You know, I'm going back to the conversation we've been having all week, Shauna, really, as part of our retail special and our focus there. And what we have heard repeatedly is about the value play and consumers really seeking out those items, especially in discount stores. TJX right in the center of that. And that's why we saw a big pop in the stock today on the back of those strong results. Well, shares of Coinbase ending the trading day lower, down just about 0.2% there. The company says it secured approval to bring crypto futures to U.S. customers. And Shauna, just a reminder, you know, this comes as Coinbase faces off with the SEC, which has alleged that Coinbase has been trading unregistered securities. The company is saying that essentially this approval today does bring a little more regulatory clarity to the crypto space, but interesting to see the reaction on the back of that.
Yeah, it is interesting when you take a look into account the fact that the stock actually closed lower. There's still so much uncertainty around Coinbase, that regulatory picture. We talked time and time again about what the timeline looks like for that, when exactly we're going to get a little bit more clarity. And we've heard from a number of investors saying that right now, it's too uncertain. It doesn't make sense to jump in here. But again, when you take a look at Coinbase, the approval here to sell crypto futures, and given the popularity on a global basis that we've seen in the derivatives market, you would think that it's obviously good news here for Coinbase. Let's also take a look at the world's second largest steel maker. ArcelorMittal here is reportedly considering a potential offer for U.S. Steel. This is according to Reuters, and this coming amid a bidding war already underway for the company following offers from Cleveland-Cliffs, also from S-Mark. You're looking at shares of U.S. Steel closing up just over 1.5%. And we know, Akiko, that U.S. Steel has become the target of a couple of companies here, takeover target, following several quarters of declines here in terms of sales, in terms of revenue. I think it's too early to know, way too early, of how this is all going to play out and exactly who U.S. Steel is going to favor when it comes to some of these competing offers.
Yeah, too early to say, but at least we have seen a pop in the stock on the back of these multiple competing offers that have now come in. It's an interesting storyline that we've been talking about, Shauna. I think worth repeating when you think about where the steel industry has gone. You know, we've talked about just how few there are left here. Any kind of consolidation would limit that even further. At the same time, we have seen some strength coming through in steel on the back of those import tariffs that have come in that have essentially sort of pushed out, or at least kept at bay, Chinese companies that have really been dumping cheap steel there. So, you know, we'll see how this all shakes down, but it certainly points to the transition that we are seeing within that industry. Well, Goldman Sachs is out with its quarterly S&P 500 beige book. The firm highlighting key issues facing company managements. And here to break down the dominating themes this earnings season, we've got Josh Schaefer following this for us. Josh, walk us through some of those themes.
Yeah, Kiko, it's been interesting to sort of take a look at what we've learned from earnings overall, right? And when you look at this report from Goldman Sachs, couple interesting things that they highlighted, three main themes here. Of course, we have to talk about artificial intelligence, right? And companies have been talking a lot about artificial intelligence. So you've actually seen artificial intelligence mentions rise about 32% this quarter compared to the same quarter last year. And you can see that graph really still going up and to the right. I found that pretty interesting because I didn't think my biggest takeaway from this earnings season was AI as it was last earnings season. But then when you take a look at it by sector, also interesting to see who's mentioning AI. So 80% of tech companies mentioning artificial intelligence, sort of telling you that tech companies still feel like it needs to be a part of their strategy. It needs to be something they're mentioning. And then you also see their real estate and communication services, some of the other top sectors that are calling out artificial intelligence. Now, another thing they also highlighted was companies talking about recessions. And we know that a lot of companies have been talking about a recession, a looming recession coming toward the end of last year, maybe first quarter this year, or during those fourth quarter earnings calls earlier this year. But you can see that number is down significantly as well. And you think back to the early part of earnings season, Akiko, when we heard from those financials, when we heard from Bank of America, JP Morgan Chase, those banks really had a positive, upbeat look on the consumer, and the consumer at least remaining resilient and not seeing a downturn. So not shocking to see that number for the recession calls there, because you think about what we're hearing this week, you're hearing Target maybe warn about that consumer a little bit. Still not necessarily talking about a recession. And again, Goldman Sachs did this research before Target reported earnings this morning. And then a final thing that was interesting to point out that they highlighted in this was volumes versus pricing, what's driving sales. That's something we've been watching a lot when we think about the story of inflation and how inflation is impacting these companies. Now, Goldman Sachs found that some companies are saying that volumes is still what's driving sales, and they're seeing less volumes, but prices are still high, so that's keeping their sales up, while other companies like Target are saying volumes are down, prices might actually be coming down, and that's what's driving sales down. So we haven't gotten a clear picture yet on where that story is going to play out. It seems a little bit mixed right now, but that price versus volume will be something to watch, especially when it does come to retail over the next couple quarters.
Yeah, it feels like not all retailers, sort of on the same page when it comes to the timeline for bringing down some of those prices that were inflated several quarters ago. I want to see if we can pull up that chart on AI again, because Josh, in many ways, we keep talking about this hype cycle, but it really was the last quarter where every company felt the need to just mention AI. This quarter, it's kind of the show me cycle, right? It is about how do you monetize this technology? And as a result of that, we have seen just sort of outsized mentions here from tech companies, because they are in fact the ones that are driving some of these investments. Have we seen other sectors really talk about the monetization? I mean, what more color have we gotten about how that technology is likely to be integrated?
There's been less commentary on actual monetization, right? And I think that's why you've seen less mentions across other sectors. You mentioned, Akiko, a lot of tech companies have been talking about it. And when we think back to last quarter, it sort of became a little bit of a running gag that everyone had an AI strategy, right? Coke was telling you how AI was going to change their business. And you could argue AI might change how factory workers work or something like that within Coca-Cola's business, but it's not exactly NVIDIA either, right? And I think we've seen less companies that don't have a direct strategy for how AI is going to improve revenue or boost revenue in the next couple quarters mentioning it, because they realize that right now, that's not really being rewarded by investors. That was being rewarded by investors when you go back 3 or 4 months ago, but you take a look at this quarter and people have been more interested in how AI is directly impacting revenues. Meta said that AI has directly been impacting their revenues, keeping people on the app longer. Stock pop almost 10%. Other companies have said that AI is going to be a little bit longer, a little bit slower of a play. Even AMD, which is considered an AI play, said, AI is going to be a little bit further down the line. And so that was something that was interesting to see, because that stock didn't react as well. So AI, yes, companies still feel like they need to mention it, but maybe not as much as they felt like they needed to mention it when we were really in the heart of that hype cycle.
Yeah, it feels like it is about setting expectations, right? A bit of reality check kicking in now. Josh Schaefer, thanks so much for that.
All right, Akiko, let's take a look at Cisco. The stock under a bit of pressure here following its most recent earnings release, and taking a look at the numbers, they actually beat on both the top and bottom line for their fiscal fourth quarter here. When you take a look at revenue coming in $15.2 billion, the estimate was for $15.05 billion. Adjusted EPS of $1.14. The estimate was for $1.06. Going back to that sales number, they're breaking it down a little bit further into their businesses. Services revenue coming in line with expectations at $3.55 billion. Product revenue beating here to the top side, $11.65 billion. The estimate was for $11.47 billion. Taking a look at some of their guidance numbers here, Cisco sees full year adjusted EPS of $4.01 to $4.08, which was pretty much in line with what the street was looking for. Consensus there was for $4.04. This is for full year 2024. When you take a look at the Q1 expectations, revenues expect to come in $14.5 billion to $14.7 billion. That was slightly higher than what the street was looking for at $14.57 billion. Yet we're looking at the stock under a bit of pressure. And the focal point here is obviously Cisco, a good gauge just to how much companies are still spending on IT. There was some speculation going into this report that maybe you could see a weak report because of how companies, they're either not spending as much or reallocating some of that spend towards AI. But at least when you look at the top and bottom line numbers for this most recent report and also their Q1 guidance, it looks pretty decent, yet the stock under a bit of pressure.
Yeah, down about 1.3% right now. Well, coming up, there's a new startup out there that wants to pay you to share your data. Find out how you can get cash. That's up on the other side of the break.
I think they would both fold in 5 seconds. I feel like Mark would bring some moves, but in the end, Elon would beat him.
It may be wise to have some sort of contingency plan.
I'll take Elon.
No need to rush, you know. Look, what's the hurry?
Definitely Mark Zuckerberg. He seems like someone who would go a little crazy and beat Elon Musk up, and Elon Musk is like all talk. It would be embarrassing for him, I think.
I think that's got to be true.
I think Mark may have the skills.
I do think it's going to be very interesting to see how this plays out.
I'll put my money on Elon, though, because I feel like he's a little crazier.
Oh, wait a second. That's the exact opposite.
People say that Mark Zuckerberg actually does like some form of martial arts.
I like jujitsu. I also really like MMA. We have like a mini academy in my garage.
So I guess my money's on him.
It's awesome. I got like a ton of my friends into it.
I don't care.
I don't know. I think Elon Musk probably.
You know, hopefully this can serve as an inspiration for excitement about the future.
I think if they both managed to kill each other, the world would win.
A tech startup helps users harness their own data and make money from it. It's announcing a $15 million investment round, Caden's Series A funding round, led by Nava Ventures and Jerry Yang, co-founder and former CEO of Yahoo. Joining me now for more on this, we want to bring in John Roa, the CEO of Caden. John, it's great to have you here in studio. Congratulations on your latest funding round. So just walk us through how your app works, how people are able to make money off their own data.
Yeah, so the Caden app, which is available on the App Store, you can basically connect up accounts that you have data in. So like your Amazon account, your Uber, your Netflix. And so we help to pull data from inside of those. So what you buy, what you watch, how you travel, into a secure wallet that you own and control. And then we show you kind of fun stats and insights, almost like the Spotify Wrapped for everything, like how much money you spent in your life on Amazon or whatever. And then in a secondary step, we offer to pay you if you want to share your data anonymously with us at Caden. And so it's a way to safely and securely make money from your data with no kind of extra effort needed on a daily basis.
John, how much of this was brought on by the privacy restrictions we've seen through Apple's iOS, but also regulation that has come through in places like California, but also in Europe? And what are you hearing from clients who are saying it's increasingly hard to sell these targeted ads because we don't have enough data?
Yeah, the regulation and a number of other things from Cambridge Analytica to data breaches have really spawned an entirely new revolution/disruption in digital that's somewhat unprecedented. The government has never stepped in from a regulatory standpoint to change digital this much. So you mentioned first-party data and advertising. That's a huge area that's getting affected, alternative data. So we wouldn't exist without those tailwinds. And ultimately, the entire industry that's going to form kind of with and around Caden is all here for the same reason.
John, how much control do the users have in terms of what data they're sharing? And I guess, how are you using that, if you are giving them that option, to kind of win over their trust?
Yeah, trust is paramount. Without that, we wouldn't be able to succeed in any stretch. The way that we allow users to control the data today is kind of, do you want to share anonymously or not? And we don't have a way to do it more kind of specifically today because we completely remove any notion of their private information. So anything that makes me John and you Shauna kind of goes away. Later on, it'll be kind of more clear on to say, I want to share this data with Netflix or this data with Uber or Amazon for a specific purpose or reason. And so that's kind of the evolution that we're going in.
You know, John, this reminds me of a conversation that I think's been happening over the years, which is, these apps that have really blown up. We keep saying they're free, but the argument has always been, well, they're not free because you're sharing your data there.
That's right.
How do you value the data? I'm curious in the collection of what you've got, because you're trying to monetize the data alone.
Yes.
What is the most valuable?
Yeah, it's a great question. And this is where a lot of companies who have come before us have struggled, is to find out kind of where the unit economics work to make data valuable enough to build a company around it. And so the most valuable data is us as a collective. It's not specifically what Akiko buys or what John watches. It's about all of us together that can either predict future trends, can look back at kind of past behavioral information, and to help businesses make better decisions ultimately for the future. That's why we're kind of going the anonymized and aggregated route, and that's where a lot of our business products are founded.
How much money could people potentially make when we talk about what data is valuable versus what's not? I guess, how does that then relate to the income that maybe someone could potentially get if they do use your app?
So today, about $20 a month. And so we ask for a couple minutes of work up front and then nothing else. No pictures of receipts, no taking surveys. You kind of set it and forget it and make money every day. So no one's retiring on it, but it's kind of like free Netflix in a very kind of safe and private way. By next year, we want that to go to $50 a month or $600 a year, and then up from there. So we're at the early innings of kind of maximizing on our profit and our promise ultimately, and that's going to be where we go with users today.
Finally, John, a question that's not specifically tied to your app, but you are talking about your latest funding round. We've heard, at least within the VC space, that there's a lot of capital on the sidelines. It's not necessarily being deployed right now in a big way. I mean, what have you seen as a startup in terms of what's happening on the private side of things, and how much of that funding is coming back?
Yeah, this is a tough time for early stage companies. This is my 25th year in a founder role and my 7th company doing this. So I've seen a lot of cycles. I've done a lot of fundraising. This is about as challenging of an environment that I've seen despite all that money sitting on the sidelines. I think great businesses will continue to get funded, but there's going to be a lot of signal to kind of remove from the noise that is startups in 2023.
And the scrutiny that comes along with that funding, I mean, how does that differ from your past experience, past cycles that you've seen?
Yeah, you have to be fundamentals based today. As much as you maybe could get funded by just saying you're an AI company, or 2 years ago that you're a Web3 company, it's going to work less and less. And so you have to be a fundamentals based business. You have to think about cash flow and profit and all the things that make businesses great in the long term. And investors are looking for that today. But again, if you can show a compelling story for growth, there is capital ready to be deployed, like our story.
All right, John Roa, great to have you here in studio. Thanks so much for coming in, CEO of Caden.
Appreciate it.
All right, next up, we are going around the horn with today's top stories. Allie and Josh standing by with a closer look. Guys, what are you going to be talking about?
Hi, Shauna. Well, it's a gift that keeps on giving, right? The Barbie movie, and Margot Robbie, she's having a pretty big payday.
She is. We're going to give you all the details on her income coming up next.
In a surprise move, China's central bank cut 2 key policy rates after a broad array of data across retail sales and investments came in softer than expected on Tuesday. Will Beijing's latest move be enough to jumpstart the economy?
The data releases we've seen over the last week or so have been not just weak, but I would say outright alarming. Now they're cutting rates by 10 basis points. It's hardly a game-changing policy. I would say we're getting to a point of like incoherence in the policy framework, which is not really generating confidence. And you can see, okay, we had a rate cut and equities were down, right? So that's not what you want to see as a policymaker.
So China ramping up its easing efforts, more concerning economic data coming out today. How much trouble is China's economy in?
The Chinese economy is definitely under a significant amount of stress right now. The key thing to watch here is the real estate sector. This has been now the 28th month of declines in new construction activity since it reached its peak in 2021. And that has a big impact across the economy, not least on local governments who have relied on land sales to balance their books for years and are now under a considerable amount of stress.
Chinese officials are reportedly considering cutting the stamp duty on stock trades in order to boost the world's second largest equity market.
This measure would really be a boost for Chinese equities if they were to cut that stamp duty. A stamp duty is like a levy on stock trades, and this would be the first time that it's cut since 2008.
Chinese economy has been sputtering without doubt. Something that has bucked that trend has been Chinese crude imports. But if you look at everything else on the macroeconomic front, whether it be their exports, their industrial production, manufacturing activity, deflationary pressures, all of that is just big bad news in bold letters.
I've been covering China for about 20 years. I've never seen this type of weakness where it feels like you have a real confidence issue, and that's certainly going to have spillovers into stock markets around the world. I'm surprised we have not seen more spillover. Like, given the severity of this consumer confidence crisis in China, I think we will see more spillover than we've seen to date.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, can I speak? Joined by Josh Schaefer and Brooke De Palma. And guys, we're talking Barbie, which we normally do on the roundtable, but this is interesting because Margot Robbie, the star of the film, she's expected to make a heck of a lot of money from this, $50 million in salary and box office bonuses. And this immediately brought me back to way back in the day, not that long ago, if you can believe it, but during COVID, remember when Scarlett Johansson, she had that massive lawsuit against Disney because they decided to put Black Widow on Disney Plus and skipping the theatrical experience entirely. At that time, Scarlett Johansson said she lost out on a lot of money due to those box office bonuses, which, as we're seeing, is a really significant part. So as the actor strike is ongoing, that's something that I've been thinking about that actors are fighting for when it comes to this new streaming age revolution. But then, of course, for Margot Robbie, pretty good payday right now.
Very good payday. And I often wonder how much exactly these stars, these celebrities make from each movie that they're in. I mean, they're turning out one per year. We were just chatting about some of Margot Robbie's other films. She was in Babylon, she was in Wolf of Wall Street. And to see this significant of a payout, $50 million. But when you think about the billion-dollar franchise that it is that a lot, would you say?
I would say it's pretty significant. Yeah. To your point, right? These stars, only some of the big ones, they only do a movie a year, if that. I mean, Leonardo DiCaprio, he's pretty picky with the movies he does because he has the ability to make a lot of money. It just goes to show, even though there's a lot of turmoil in this industry right now, there is still a lot of lucrative opportunities at the box office.
All right, so I'm trying to get a little bit of perspective on the numbers, right?
Okay.
So Barbie just passed Batman: The Dark Knight, one of my favorite movies of all time, for total domestic box office. And so I looked up how much Christian Bale made off Batman. Quick answer off Google tells me he made $9 million off Batman Begins, $10 million off The Dark Knight, $15 million off Dark Knight Rises. Then when you add in some of the bonuses off the trilogy, so all three Batmans, which I would consider very popular movies.
Very popular, yeah.
Christian Bale made about $50 million, and we're talking about
we're
talking about Margot Robbie making $50 million off one movie. Now again, remember, The Dark Knight came out in 2008, so a little bit of a different. That was a long time ago at this point for how much people made.
That was also peak box office, right? Peak theatrical.
And also, too, I remember the theaters being absolutely packed for that. So you have to imagine that the people attending, the tickets that were sold for that compared to what we're seeing now, perhaps is similar, but you weigh in inflation, you weigh in all that fun stuff, how much more ticket prices today than they were back in 2008, and maybe perhaps, the cut that she's getting, how does that compare?
She's a producer on this movie too,
correct,
which
correct,
we should
right.
point out.
And I think the thing for Barbie with me when comparing it to The Dark Knight too, that you just think about is like, in 2008, we were going to the movies regularly still, right? Barbie to me has been one of the I think it has been the biggest talking to friends, people are going to see Barbie moment since we've got out of the pandemic, as far as just, I'm actually going to the movies. You don't talk to people often anymore and ask what they're doing over the weekend, and they say they're going to the movies. The past 3 weeks, people have said
I did too.
I
You're the only one that
hasn't. Oh, gosh.
I saw Oppenheimer. I haven't seen Barbie.
Okay, that's good. You saw one of the two.
Exactly.
But yeah, I do think it's just a cultural moment, and people want to be involved in the conversation.
Yeah, and really quickly on that culture moment, I did read that 75% are under the age of 29 who are going to see this movie. And I can't help but think, what does this mean for Halloween sales? Are we going to see more Barbies walking around?
Kens.
And in addition to that, I like to think of a female empowerment. What does this play in this future of, film director schools, of, females going into film? And so further implications down the line, I think, for sure.
Well, if you want to look like Ken for Halloween, you probably have to go to the gym, right? And that's my story today. I want to talk a little bit about some of the trends we've been seeing at the gyms. So a story out in the Wall Street Journal today pointing out this trend that we've been covering for a little bit over a year now, gyms building out office spaces and gyms being increasingly interested to have office spaces within their gym, charging members more to go to the gym and be a part of that office experience. Lifetime Fitness, who we're showing right now, is one of them. Some of these memberships can cost as much as $400, $500. So basically the theory is you can go to the gym, then you can hop on a couple Zoom calls, then you can go back and stretch if you want to, or you can leave. But the process of basically having a place to work remotely and sort of live remotely for several hours during the day to kind of get away from home for some of these remote workers is interesting to see developing at a time, we should note, where WeWork says they're not sure if they're going to be able to continue their business, and there is a part of this that does sound a little bit WeWork-like, at least to me.
Yeah, well, there's home, there's work, and then there's this third space that's now being created. I'm all for this. If I was working from home the entire time, it sort of reminds me like a Soho House or one of those private membership clubs. I like getting out of my apartment. If I was working from home all the time, I couldn't imagine working, sleeping. You feel so trapped, and I feel like there is a market for this third space, but different than WeWork though, I think the fact that you can kind of do a 2-in-1 sort of thing. I can go to the gym, I can use a steam room, I can create this self-care environment for myself while also being able to work is that added bonus.
All right, I got to throw it back on it. Then aren't you just in the same building for too long again? If you go to the gym and then you also work there, and then it's 8 hours later, and you're like, wow, I'm still in the same building.
Apparently, Lifetime smells really good. They probably are playing music.
I didn't realize
they probably do infused with like eucalyptus, lavender.
If it smells good, I'm in. Never mind.
I could work in a fancy coffee shop all day long. That's a much different environment than my apartment where I'm alone, I'm isolated. At least there's other people around.
But I like the coffee shops because you can go to different ones too, and I think that's the one thing I wonder how
there's
this
different
scales.
lifetimes,
right? Sure. I just I like being able to be flexible, and so I wonder how many people want to do this and want to pay for it, right? Because if you are working at a coffee shop, it's not necessarily.
I wonder if you can write this off for tax purposes, right? Like this is my
interesting.
office.
I just can't get over though how much it does cost. I mean, you said $499 a month. Is that right?
At some gyms, yes. At some gyms, I think it depends on the location and the brand, because this isn't just Lifetime Fitness doing it either. There's a couple other gyms
and
building it out.
Lifetime is like pretty creme de la creme, like pretty.
Oh, it's a nice gym.
It's a very nice gym.
But now you can't have physical wellness without mental wellness. And Google is getting into that space. They're out with a AI assistant that offers, get this, life advice. So ultimately, this is new AI tool that offers life advice, like interpersonal conflict advice between friends, planning instructions, tutoring, and reportedly they're working with over 100 people with PhDs to develop this. I thought it was super interesting. I mean, I have some hot takes too. I can see you guys both looking at me.
Oh, I know Josh is gonna have the hottest takes.
In person,
I don't think it's a
dealing
hot
with your
take
problems.
to say that I would never take life advice from a computer.
Google.
I think that's probably a common take. I mean, the tutor part makes sense, right? When you think about AI, it's only able, you don't want it to have human capabilities either. That's when we talk about AI being scary. I don't really want the computer to be able to think like me. But if it can synthesize information and tell me information that's online, then that's great from an educational standpoint. I don't need it to tell me what to do with my dating life. like I don't need AI to tell me how to feel.
Well, do you trust your friends or do you trust the computers? Some people's friends may not have the best advice.
I trust my friends and my family. I trust human interaction. It's a crazy thing in this AI world to think that I'd still want to talk to a person, but I would say I side with that.
Yeah, one thing that I was happy to hear is that this won't give mental health advice. It is going to ultimately allow users and encourage users to seek professionals. I was really happy to hear that as an
so it
advocate.
feeds you to
mental health support centers,
cool.
which is good to know.
Yeah, that is good.
But what I did find fascinating was that late 2022, Google users, they Googled how to handle stress, how to stop a panic attack, how to cure depression. And so people are really turning to Google for these type of answers when it comes to not only mental health issues, but really real world problems that maybe they don't feel comfortable going to their friends to ask, or maybe it's like one of those very personal questions that you're really curious about.
It's making me want to go back in my Google history.
Right? I'm curious, what did I
You could
Google?
totally say you could
Google
Google a lot of
things?
those things,
Okay,
right? Yeah, because you want the answers, right? It's just, do people actually want to have someone talk back to them? I don't know.
I feel like that's why sites like Reddit are so popular too.
Right.
Like people pose these questions on
very
public
niche
forums.
communities where you're really able to interact. But that's the thing, interact with the community.
True.
Right.
This AI component to this completely eliminates that, and that's what I don't like to see here. I feel like the internet was really, founded for people to find answers, but also interact with others, and now we're sort of losing that a bit.
Yeah, right. You lose the connectivity of it, right? Maybe it'll be nice eventually they'll be able to have it just immediately put you on call with someone or something. You can, depending on what you search, there's people that are sort of sitting there on the other side. There's an idea.
Right. I like that.
They probably won't
I like
take
that,
it.
Josh.
Yeah, they probably won't take it.
They probably won't take
there's an
it.
idea.
Here's a business. You can start the business. There you go.
But let me give you a quick example. They did say that the problem that they are using it for is an interpersonal conflict. They said they have a really close friend who's getting married this summer. She's a college roommate, but she just lost her job. She's looking for money, so definitely looking to weigh on situations like that.
I want to know the answer that they would give to that.
We'll talk offline.
But we have more answers coming up on the other side of this break. We're continuing our retail special. Stay tuned.
Retail crime is on the rise. Target and Home Depot are among the names struggling with a big jump that we've seen in organized theft. And just a few days ago, a Nordstrom store in Los Angeles was the target of a smash and grab robbery. And according to the LAPD, more than $300,000 worth of merchandise was stolen within minutes. For more on what we're hearing on this issue this earnings season is Yahoo Finance's Brooke DePalma. Brooke, it certainly is a very costly issue for these retailers.
Very costly. And they actually called that Nordstrom theft a flash mob robbery. I thought that was really interesting, the way that they framed that. But as you noted before, so many retailers are seeing shrink, what they call theft, as well as loss of items to shoplifting, damage, as well as other errors, really hit retailers' profit this past quarter. And as we make way into this week, retailers certainly weighing on this issue. This morning at a call with investors, Target CEO Brian Cornell saying that the team is seeing a, quote, unacceptable amount of retail theft and organized crime. Take a listen.
Shrink in the second quarter remained consistent with our expectations, but well above the sustainable level where we expect to operate over time. And unfortunately, safety incidents associated with theft are moving in the wrong direction. During the first 5 months of this year, our store saw a 120% increase in theft incidents involving violence or threats of violence. As a result, we're continuing to work tirelessly with retail industry groups and community partners to find solutions to promote safety for our store teams and our guests.
And Target CFO later went on to say that their long-run expectation is that shrink rates will moderate from today's unsustainable levels. But so far, they're only seeing indications that loss rates have sort of plateaued, and they're not seeing that loss rates have begun to come down. And on Tuesday, Home Depot executives also weighing in their report. Then take a listen.
From a financial perspective, shrink has been a consistent pressure over the last several quarters and even the last few years. And it's something we're tackling every day.
We are certainly in a battle in retail as we kind of think about shrink, but we've always continued to lean into initiatives that we've seen that can have impact to mitigate overall.
And tomorrow on Thursday, another consumer bellwether, Walmart, is expected to report its earnings report. And so we'll have to stay tuned to see if shrink or theft and its impact on profits is mentioned at all. But when we spoke to Doug McMillon, CEO at Walmart, back in May at their annual shareholders meeting, he did say that they're most concerned about employee safety, that they've had a lot of experience managing it. They also said that it's helpful that this year they're seeing lower inventories levels because shrink tends to correlate with higher inventory levels. I thought that was really interesting. He also said it does vary by market, and they prefer to never lock items up.
So you've highlighted, Brooke, what we've heard from executives about this issue. What are experts saying?
Yeah, well, I did speak to someone from the National Retail Federation, and he said in his 35 years in business, he's never seen the frequency and the type and the amount of theft like we're currently seeing in this environment. He said it's really beyond a retailer problem, and it comes to the government that has to weigh in, the community, the retailer, and even the consumer who really needs to turn and sort of, alert when they're seeing this sort of behavior. But in addition to that, he also weighed on the impact, the toll that this takes on the economy. When you think about these sort of theft, it's hurting local tax dollars, and ultimately it's taking away money from other community services that we could be using those tax dollars for. He also said that if, these items are locked behind shelves, it ultimately then will impact perhaps sales for the retailers. But ultimately, we're already seeing it impact retailers' profit. And lastly, he said that it's really an ongoing continued relationship between retail community and online marketplaces. What we're seeing is these theft, these stolen items then appear on third-party sellers. And just recently, Congress passed the Informed Consumers Act. And when I talked to an attorney at the FTC, he said that they've been given the task to implement a new baseline requirement that ultimately has to make online marketplaces to verify and to some extent disclose information about high-volume party sellers. And so really all hands on deck when it comes to this issue of retail theft.
Certainly is. Brooke DePalma, thanks so much for that. We're going to stay on this topic because, as Brooke said, Target CEO spoke out today in its latest earnings call on the unacceptable amount of retail theft and organized crime. The retail giant, among many others, continuing to face inventory shrink in relation to rising theft this year. As part of Yahoo Finance's week-long special Retail Evolution, the New Era, We're digging deeper into the legal landscape of retail crime. Here to discuss, we've got Mark Claxton, former NYPD detective and Black Law Enforcement Alliance director. Great to talk to you today. You know, Brooke sort of laid out the problem for us, but that 120% jump number that we heard from Target today, really standing out in the first 5 months of the year. What's driving this?
Successful outcomes for the thieves. They're in a position now where these type of flash robberies, these smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
And what should that look like when we talk about policies that need to be implemented? What should be the priority there?
It's a multi-pronged approach. I think one thing for certain is that the commercial establishments have to really get back to the basics and work on increasing the technology that's available for safety. They also have to consider inventory, which was touched on just earlier, about inventory, how much inventory can remain in their stores, and then even work on restructuring interior design, the designs of their establishments, using some different materials in order to secure inventory. And then there has to be some work done on the part of legislators, and that may require new legislation or enhanced penalties for existing legislation related to these type of robberies, these type of gang robberies, which is what they are, because in the drop of a dime, they can turn fatal because there's a tremendous amount of force being used. And then there has to be a collaborative effort on part of law enforcement, increasing resources. And that's a challenge given the manpower issues that law enforcement is having across the nation. And then the prosecutor's office have to recognize that this is a disturbing trend that needs to be addressed and dealt with quickly and swiftly. And those individuals who engage in it and who are apprehended must face severe penalties.
Mark, when you look at some of these smash and grabs, I mean, it doesn't feel like there are certain items that are being targeted. And yet you just said this continues because for those criminals, it is lucrative and successful. I mean, what does that secondhand market look like? Where are they selling to? Where are they making their money?
Well, we have to be mindful that a lot of these more recent smash and grabs are involving more high-end materials, high-end stores. And so, you know, they're making a lot of money in selling to online vendors and other underground kind of backdoor establishments that deal in stolen merchandise on a regular basis. So you have this surge of high-end, very expensive product now being available to these underground resources.
So, Mark, how do you crack down then on the third-party sellers here when we talk about the fact that so many of these items are listed on Amazon, they're listed on Walmart? There was a new law that was passed earlier this summer in an effort to try to stem some of this, but it doesn't sound like that this new Informed Consumers Act is really working that well.
Well, it's still very early, but I think we're on the right course, and as far as holding those people responsible who serve as the second line in passing this merchandise over. I mean, quite frankly, throughout the nation, it is a crime to possess stolen property. So if an individual or a merchant is in possession, knowingly in possession of stolen property, they can be held legally accountable right now. So I think we're going in the right direction. We're trying to make sure that there's kind of a truth in advertising, if you will, and that merchants are are more responsible for the product that they bring into their stores.
Mark, you know, when you look at how this has been handled in California, for example, you have the Attorney General who's now teamed up with some of these retailers to try and crack down on organized crime. I mean, how important do you think it is for law enforcement and retail to essentially partner on this issue, just given the scale of the problem at this point?
It's vitally important. It's necessary in order to have any kind of impact, any kind of positive impact on decreasing these incidents. Like I said, there has to be this kind of collaborative effort on the part of the commercial establishment, the merchants, the law enforcement, the prosecutor's office, and legislators. and we have to really put additional pressure on those third-party vendors of these items as well. So it's important that there is this collaborative effort in order to stem this tide.
Mark, do you think we've seen the worst of it when it comes to retail crime, or could this be a problem that continues to escalate?
I'm predicting that it will continue to escalate and get worse. There is a certain boldness that's accompanying many of these smash and robberies, and I think, unfortunately, it will get worse, and there will unfortunately be some fatalities at some point because they're becoming more violent, more aggressive, more frequent, with more people. So I'm pretty sure at some point there's going to be, regrettably, a tragic incident connected to it. And I think at that point there may be the type of focus that we need to pay attention to what's happening.
There certainly needs to be a lot of focus on this issue right now, given the risk. Mark Claxton, great to get your perspective. Thanks for joining us.
Thank you.
Well, coming up, it's closing time here at Yahoo Finance. We will recap the top stories of the day and also get you set for everything you need to know tomorrow. We'll be right back.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Target shares closing the day higher despite a mixed earnings report. The retailer posted better than expected earnings in the second quarter, but revenue came in lighter than expected. The company was also hurt by backlash to its Pride Month merchandise. The company says it sees more headwinds ahead, lowering its full-year guidance. Meantime, stocks turned lower after the Fed released the minutes from its most recent meeting. Fed officials see upside risk to inflation, which could mean more rate hikes ahead. There were two officials who supported keeping rates unchanged at the July meeting, citing the risks to pushing the economy. All of this comes, of course, ahead of the Jackson Hole Economic Symposium taking place next week. And President Biden is celebrating the first anniversary of the Inflation Reduction Act. The signature climate bill, which set aside billions of dollars for manufacturing investments in clean energy and EV tax credits, also aimed to lower the cost of health care and prescription drugs. At an event at the White House Wednesday afternoon, President Biden once again blasted Republicans who opposed the bill, but then touted the funding their districts received.
Now here's a look at what to watch tomorrow. All eyes are going to be on Walmart earnings ahead of the open. The retail giant reporting second quarter results, and it comes after a mixed report from Target. The concern is about the health of the consumer as Target slashed its guidance, but one analyst is bullish on Walmart, Evercore adding the stock to its tactical outperform list, citing solid traffic and the ability to capture market share. Other retailers on tap to report earnings, Ross Stores and Tapestry. Investors will be watching the results from Tapestry, the parent company of Coach, after it announced its acquisition of Capri Holdings. The move aims to bolster Tapestry's portfolio to take on luxury retail houses carrying an LVMH. And after the close, investors will be watching results from Applied Materials, which will be another look into the chip sector. On the economic front, we'll get the weekly reading on jobless claims as well as the Philly Fed Manufacturing Index. At noon, Freddie Mac will be releasing its weekly look at mortgage rates. We could see the 30-year fixed mortgage rate hit 7%. That does for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here tomorrow, 3 p.m. Eastern Time. Have a great day.